Selfwealth Live series where we're building up to a core portfolio. That'll be next week. But for tonight, we're going to be talking about 5 of the key themes that pretty much every investor should be aware of. We've got Cameron Gleeson joining us from Betashares. So he'll be up in just a moment. But as always, even though I am pre-recording this, I know many of you will want to hear this week's joke. So here it is. From Dad Says Jokes. My wife says the salads I make tend to be a bit on the dry side. It's definitely something that needs addressing. That's my joke for this week. And I know some of you will be watching this live and thinking that's a 10 out of 10. So thank you in advance for those scores. Indeed, it is always a bit of fun. So we're going to be talking about a few different things tonight. We're going to be talking about ETFs. We're going to be talking about financial products as they're known in Australia. So what's really important to understand is that any of the information mentioned in the Selfwealth Live videos contain general financial advice only. Information has not taken into account your needs, goals, or objectives. So you should not act on the information until you've spoken to a licensed and trusted financial planner. I know everyone listening to the live show have seen this slide before, but it's really important to understand. My name is Owen. I am the sole director and founder of the Rask Group, which is corporate authorized representative number 1280930 of Waddle Partners AFSL 383169. You can learn more about what we can and can't say, what we do, and how we are regulated by reading our financial services guide over at the Rask website. Finally, the views expressed in the live streams are solely those of myself and or our guests and do not necessarily reflect the views or opinions of Selfwealth. Now, the reason I'm recording this in advance is because I'm going to be on the road in Queensland at the time that this goes live. But I know Rob will be live with you, and he'll be so excited to see that there are 2 bonus disclaimers here in the show. You can see the first one here from Selfwealth and the second one from Betashares. It's really, really important just to have a look at these disclaimers and just remember, once again, that you should consult the licensed and trusted financial planner before acting on the information. So like I said, we are part 3 of the way through a 4-part series on ETF investing and building a core portfolio. So far, we've talked to Ali from Betashares and we talked about her journey and the market overall. We talked to David Bassanese about the economy. Is the market going to crash? Isn't it going to crash? Why it pays to have a long-term perspective. And tonight we're talking about 5 investing themes to rule the 2020s, but also just more broadly, what are the themes that are on the mind of Cameron Gleeson. So we've got Cameron joining us in just a moment. I'm excited for that. You may remember that Cameron did appear on the Selfwealth Live program a couple of months ago, I'd say now, but it is my pleasure to welcome him back to the show. Cameron, welcome back to the show, mate. Selfwealth Live, good to have you.
Great to be here, Owen. Good to see you.
Yeah, I know you're a busy fellow. We're recording this on a Friday, Arvo, so we're recording it in advance, and it's always a bit of fun to chat to you, mate, so I do appreciate you making the time. We spoke last time about different themes. I think we spoke about something that I'm going to bring up again today, which is the kind of the talk of an ETF bubble, so to speak. But I'm curious, so far this year, what are some of the things maybe that have potentially caught you by surprise?
Well, I mean, in terms of markets, I think the rally in some of the large US tech stocks has certainly been something which has sort of caught me by surprise. It did feel like they were potentially a little bit oversold, a little bit of a dour mood when it came to what were previously seen as some of the greatest stocks in the world, but potentially a rally of sort of 30 to 40% across that group has been I guess quite surprising.
Yeah, I've got to admit, there's probably 2 things. One thing for me would be that. The other thing would be probably the emergence, and we're going to talk about this in just a moment, of fixed income. So bond ETFs all of a sudden becoming interesting after so many years of people thinking, well, maybe these don't have a place in my portfolio anymore. And it seems, well, people are now looking back at that. So a lot of the things that we talk about on the show, Cameron, are ETFs. It's fair to say Betashares, the biggest provider from the number of ETFs, and one of the biggest from the total amount invested in ETFs here in Australia. And so what this gives rise to is an importance for investors to think about which ETFs they are interested in, which they aren't. And I'm curious to hear it from your side. What are the things that you look at when you want to get a quick read on an ETF, like how it might fit, or even if it's worth investing the time, into researching that ETF? What are some of the things that you immediately look at?
Yeah, so I mean, the first thing to think about when you're looking at, and it doesn't have to be an ETF, it can be any investment, a managed fund or otherwise, but is to sort of understand what role you were looking for that investment to play in your portfolio. Is that a core allocation? Is it a satellite allocation? Is it there for capital growth, for income, for defensiveness? And I like to go to the fund provider or the ETF provider's website. Depending on whether they're an ETF, ETFs are often very, very transparent in terms of what you can find out. But sometimes, actively managed ETFs or actively managed funds aren't quite so transparent, but might look at the fact sheet, get an understanding of if it was an equity ETF, what sectors it is exposed to, and think about how that ETF is going to overlap or complement existing holdings in my portfolio. Looking at an ETF that perhaps duplicates something else I have in my portfolio, that might be questionable, but where it can complement and provide an exposure that I'm looking for, I currently don't have, that's great. So thinking about that sort of overlap, thinking about fees, and thinking about, for example, if it was an index tracking ETF, how well is it tracking its index? Is it being run efficiently by the ETF manager? They're just things I'd start with.
Yeah, and that's a really thorough lesson. Such a short answer there. I really do appreciate that. So you've got kind of, the what is it actually getting you exposure to? Going to that fact sheet, going to the PDS, or just going to the website and checking those things out. Seeing or understanding the fees and how that might fit in your fee budget or fee allocation if you're building an entire portfolio. But then also just actually popping the hood and seeing what's inside. Obviously, you said ETFs are more transparent typically than active fund management. And we'll come back to that in a minute, perhaps, because that might be one of the things you touch on. But I'm curious, like, how do you think about if you're building a core and a satellite portfolio? If you're an advisor, you're building strategic asset allocation versus tactical. How do you think about perhaps what goes in either bucket? Like, is there particular maybe types of ETFs that go one way or the other? Is it maybe based on fees? Like, how do you think about that?
Yeah, that's a great question. When I think about portfolio construction, let's talk about a core and satellite approach, and we start with a core. I mean, that's really that's your anchor for your portfolio. What we're obviously looking to do there is to build a portfolio by blending asset classes, growth asset classes, and potentially defensive asset classes to benefit from diversification. And we're not necessarily trying to outperform the market, or that can be obviously a good thing to do. We're really looking to drive the highest level of total expected return for the level of volatility or risk that I, as an investor, can stomach. Because the core of the portfolio is the bit of your portfolio you want to be comfortable in throughout the market cycle, so that you can continue to invest regularly on a monthly, quarterly, or annual basis, even when the market has turned south. And so from my perspective, it's quite good to think about what sort of things do I want to add to that portfolio. I'm likely to look to add some really super low cost, broad market exposures, particularly in equities. But I'm also likely to look to add complementary exposures. So, to give an example, if we think about an Australian investor, about half of our equities might be Australian equities. We know that they are quite cyclical in nature. And so if I'm looking to allocate to global equities, what are some of the sectors that I'm perhaps underweight in my Australian equities that I could draw on in global equity portfolios? And, for that reason, I may look to, use, for example, a global quality ETF, or, for example, NDQ NASDAQ may be complementary in terms of helping round out that portfolio and creating diversification across the asset class. So they're the sorts of things I think about, is low cost diversification, and broad market beta can really help there, but then complementing it with particular styles that are also very much diversified, reducing stock specific risk to round out the portfolio. So that's the core. Satellite, very different. That's generally where you're looking for outperformance. So if you have a view, that's where I express it. And I like to be very clear as to segregating those two parts of my portfolio, because, typically what we see is when things go against an investor with their satellites, they tend to stop investing in that space. So having that core there means you're going to continue to invest over the long run.
Yeah, I like that. So talking about, like, I think that's a really interesting way to frame it, is like, what have you already got in your core portfolio? And what are you exposed to here in Australia? What can't you get in Australia? Look abroad, use that as a framework to begin building that part of the portfolio, focusing on costs and diversification, as you said, really important. I've also never, well, not that I've never heard it, but when we think about outperformance, and we'll talk about this in a second, like outperformance, typically that's brought up by stock pickers or active fund managers who are trying to outperform an index. But I really like how you put that there when you think about the satellite in other ways. That could be, thematic style ETFs, could be sector-based ETFs that maybe outperform or do better than a traditional index or a traditional, like the broad market overall. So that's kind of great. And that's the kind of specific focus for tonight's show, which is just getting a handle on some of the themes that are maybe playing out. And your role sits between kind of portfolio management and what's going on in, I guess, with themes overall. So you're kind of perfectly placed to answer these types of questions and be our field guide. In anticipation for tonight's show, I did ask if you could bring a few themes to the market. And I must admit, I didn't expect you to bring many of these that you've brought. And I'll bring my screen back up here. So in advance, you did send to me, you said, well, maybe we can focus on these types of themes, the active versus passive investing and what that actually means for investors, which is kind of cool. AI and US mega technology. So these are like the big companies of the world, which we'll get to in a minute. I must admit, on being on the road, mate, I know you get on the road quite a bit as well, but being on the road, everyone is just thinking about artificial intelligence and technology and how to play that rise. The third one is a multipolar world, which I'll let you explain in a minute. The energy transition, which is fascinating to me and to all investors who are thinking about things like climate change or sustainability and so many other things as we transition to electric vehicles and remove ourselves from some of the heavy fossil fuels. And finally, the reemergence of fixed income, which we just spoke about. So obviously, I'm happy to be guided by you here, mate, but feel free to take as long as you want and to kind of pad this out for us. I'll probably have a few follow-up questions as we go through. And I think for anyone watching this, the idea is listen to what Cameron's saying and maybe start to think about how you can build a watch list, how you can identify these different themes and whether or not you actually think they're valid themes. So that's kind of our role as the community tonight. So, mate, firstly, over to you. Active versus passive as a theme. I'm curious what you mean by this and how you think it can play out in people's favor.
Great. So let's get stuck in, shall we? I guess one of the often a starting assumption of investors when they think about active versus passive is they think the choice really is between that low cost market capitalization approach. So, for example, getting exposure to the S&P 500 market capitalization weight index versus active management. And for a long time now, it has been shown that over the long term, the majority of active managers will underperform indices. And so for that reason, we have seen a trend towards passive funds. And I think this shows data for Australia year on year. In orange is the net flows or net investments into passive funds, and then the net flows into active funds shown in black. So there has been sort of a slow growing trend towards low cost broad market exposures. But what's sort of been more interesting in the last couple of years has been that an active manager doesn't have to just focus on beating the market. They can prefer a certain style of investment, whether that be quality or value, but has been the growth and the adoption of what we call smart beta or factor ETFs that provide exposure to equities, but in a particular style. And the realization that these lower cost rules-based approaches can in fact replace active managers who pursue very similar styles and essentially attempt to harvest a particular risk premium. So that's been a really interesting trend that we've seen, the growth of passive into those styles. And then another one that's been, we're going to talk about it, but fixed income. Fixed income really almost didn't exist in Australia as a asset class for ETFs a few years ago, and it has been really strong in terms of the uptake of ETFs, people using ETFs for the fixed income element of their portfolio as fixed income has become more attractive. So they're just some themes that we're seeing in terms of adoption of ETFs and the broader use of ETFs in portfolios beyond just that low cost beta.
Yeah, and that's really interesting too. Like we can see that in the orange here, how much money's flowing in. That you mentioned that even some of the traditionally, like where they're active funds, where there might be a portfolio manager that picks stocks and whatever, they're now competing not just against, say, like a broad market ETF, but the ones that might be just, like you said, focusing on the quality factor, which I know Betashares offers, is it QLTY?
LTY, yeah.
Yeah. So if you're looking at a global fund manager, you can now compare the fund manager directly to the ETF equivalent that has that kind of tilt in that portfolio, which is really, really neat. And personally, I see that as like a theme that's just going to continue. I mean, it kind of has to. The proof's in the pudding. So number 2 is in a similar vein, but it's this kind of double click on technology, maybe even a little bit of AI sprinkled in here, not to have too many buzzwords for tonight, but this idea that technology may be here to stay. And I think everyone looks to the US companies in particular, but these are maybe global companies when you think about it, and look to use ETFs to get that exposure because it's so much easier than going and buying individual stocks themselves or for whatever reason. And just to be clear here, I've got a screenshot. This comes from the Betashares website, data as of July 31, 2023. And I will make a special note here to say that just because these companies are shown here doesn't mean that it will always be the case in the future. So be sure to refer to the provider's website, in this case Betashares, before you rely solely on this, for example, if you're watching it at a later date. But this theme, Cameron, can you talk to us a little bit about this? Because we've seen, and you said this at the top of the show, really exceptional performance from some of these mega cap technology names in the US. Why you think this might still be persistent?
Yeah, so I mean, the names in the sector shown on screen are for NDQ, our Betashares Nasdaq 100 ETF. I guess adoption and realization of the potential game changer, which is AI, after ChatGPT was announced or launched to the public in November last year, really has driven the stock prices of a number of large tech companies, and we've seen that there has been some multiple expansion. So when you think about performance of stocks, we can think about that as driven either by increases in the earnings or increases in valuation multiples. Now, obviously you get a little bit nervous when valuation multiples expand. And the question that we will have, and this is one of the reasons I wanted to bring this up, is because I think we should be looking at this as a 10-year time frame, is can these companies, these large US tech companies, can they monetize this opportunity? Will they justify, this run up in stock price that we've seen? Now, I mean, it's pretty clear that a company like NVIDIA, which has rebounded very strongly, is in a very strong position even today, with the growth in its order book for its AI chips. So if you know anything about the AI training that is going on, NVIDIA's AI chips, they have about 95% market share. And it's very hard to get their chips at the moment. So they're in extreme demand. They have a very wide moat around their product, and they've got clear advantages here and now. But perhaps if we think about some of the other companies, there's question marks as to how long before Microsoft will be able to turn the hype into revenue. But I think we've seen some clues in the second quarter earnings announcement. So Microsoft, as well as obviously having a relatively strong earnings for quarter two, they also have launched the pricing for their Office 365 Copilot, which is an AI tool, which companies will have to pay an additional charge per user. So you pay for your Office 365 right now per user in your company. You'll have to pay another $30 US per user. This could be a really powerful tool. It's going to now enable you to essentially, Copilot will be able to interpret content and summarize. It'll be able to create charts and PowerPoint slides for you. So do a whole number of things. And
cool.
The potential there now, it seems a bit more real, and you can see how this can add to top line revenue for a company like Microsoft. Look, similarly, like Meta, which was in the doldrums last year, has seen a real rebound in its social media platforms in terms of the level of engagement. And that's been put down to the use of AI to essentially better understand the users and increase engagement, which drives ad revenue for them. So it's the potential for these companies to drive and monetize AI, which is really interesting. And more broadly, we know that these first generation AI models, were expensive to run, but that is only going to escalate as models become more sophisticated. And there's a relatively small pool of companies that have the capital, that have, for example, the cloud computing power and wherewithal to build these models. So those large cloud computing platforms, IT platforms are in quite a unique space to really benefit from this new wave. So that's where we are starting to see the rubber hit the road there. But in terms of bottom line revenue, it's going to take a little while for this to play out, and it will be really interesting to see that play out over the next sort of last 7 years in a decade.
Yeah, it will be, and that's a really interesting thing. I didn't see that announcement from Microsoft about the Copilot. It's a pretty cool name for the tool and the productivity that's going to come from that. I was chatting to a software engineer yesterday, and he was telling me that he was thinking of hiring more software engineers for his tech business, but he was like, to be honest, with some of the AI tools he can use now, he feels like he's 3 software engineers in one. So that kind of expansion in productivity will inevitably lead to revenue. And I think that's probably kind of more like the picks and shovels play, because you're buying Microsoft, even though that might be a tiny little bit of its revenue right now. In the future, people, or even in the immediate future, people will be paying a lot more for that. So number 3, Cameron, is this idea of a multipolar world. And we've got some charts here that have been sourced from the net. And these just show basically manufacturing and new technologies, both globally and across the United States. And my understanding of this is basically, we can see, and we'll touch on this in the next point as well, this idea of like a rise of China and other places in the world, maybe outside the United States, and we just spent a lot of time talking about that, that may play a big role in coming decades. So people know about this, like this is not new information, but I'm curious to hear your perspective of why now, and how to go about it, basically.
Yeah, so there's obviously a lot of angles we can look at in terms of the concept of a multipolar world. But if we're just thinking back from pre-pandemic, and I want to focus on manufacturing and supply chains and critical technology, because there's some clear implications there. If you look at supply chains prior to COVID, they were optimized for cost. Lowest cost was key. So you had just-in-time inventory, no consideration for sovereign risk or contingency. Now, clearly, we saw with some major hindrances to supply chains, that became problematic. But beyond that, the heightened geopolitical tensions, and we can sort of talk about US, China, but we can also talk about Europe, Russia, has meant that people have woken up to the fact that you need to have more control over that supply chain, and it has potentially grown too complex, and too many dependencies on parties you don't necessarily have leverage with is dangerous. So we've had the growth of, or increased frequency of terms being used like reshoring or friendshoring or nearshoring. And this is just really talking about reshaping how we supply particularly goods to our economies. If we think about areas where this has become critically important, it has been some of those technologies like semiconductors, and also like the energy transition and the technologies, for example, batteries and alike, where Western governments have become somewhat concerned about the control of supply chains. Now, I think the chart that you showed there before, you talked about the share of manufacturing globally, and we know that China is the world's factory. It certainly was. And the US has manufacturing capacity about 15% of global capacity, versus China about 30%. But what's been interesting is the Biden administration has launched a number of very, very large programs, including the Inflation Reduction Act, which essentially provides incentives for the manufacturing of green technology, whether it be battery, solar, wind, EV cars in the States, and also the CHIPS Act, which is to incentivize the production of semiconductor chips within the US. And the increase in spending and the build out has been absolutely enormous. So, roughly $200 billion worth of factories being built to basically, build semiconductors in the States, and around about $130 billion across batteries and electric vehicles. Huge build out incentivized by tax breaks. And it's really the US trying to wrestle back control of their supply chains of these critical technologies. Now, I mean, it's got some interesting upshots, because the US has potentially hollowed out a lot of its manufacturing base. And there are areas of these, I'll call them more advanced manufacturing processes, where they're probably going to have to rely on some of their friends like Japan, who has pretty good expertise and has a workforce which has good expertise in manufacturing semiconductor chips. So there'll be some, realignments of supply chains with countries like Japan and the US, but also the requirement to build out manufacturing capacity in the US, which is a higher labor cost market, means that we're going to see an increase in manufacturing automation, and that's pretty clear to see. So some of the leaders in that space, some of these robotic companies, for example, Fanuc is a Japanese company which has about up to a 50% market share in industrial robots in some segments in the US. Swiss company ABB, Canon. So there are some names in this industrial automation space, which I think are really sort of well placed to benefit from this retooling of the US economy. And the technologies like AI, the ability for AI to be utilized to create robots, which are going to be able to be used in different manufacturing processes where they weren't formerly used, is also really interesting. So if we talk about industrial robots, in the past that's dominated what we call high volume, low mix manufacturing.
Okay.
So to think about that, that's like a car assembly line, something where this robot does one job, does it again and again. The growth in robotics, a lot of this will come from what we'd call higher mix, lower volume manufacturing, and also spaces like healthcare. And so, the use of technology to provide situational awareness of a robot, so vision and other sensors, is critical, and it allows greater penetration of automation in factories. And that's really important because we know, firstly, the workforce in countries like the US and indeed in China are actually shrinking as a proportion of the overall population. But also it's relatively expensive to employ people in the US, and they don't necessarily have the skill set anymore they used to. So that's going to be a really interesting space to watch over the next certainly the next 5 years, and I would say the next 20 years, is that automation of workforce, and also the realignment with countries like India and Japan and the US.
That's a really interesting mix of geopolitical changes, but also, or potential changes, but also the technology shifting overall as well. And I feel like, so as someone that is both like an investor who loves to pick individual companies, but also ETFs, I feel like to learn the steep learning curve, to learn who would be the winner in that industry. And I feel like an ETF as a product overall can provide the exposure that most investors would want to get, like a really good base exposure to all of these global companies, rather than venturing to Japan and all over the world, Europe, and then America, and all that sort of stuff.
Yeah. I mean, to talk to that, I mean, so we have Betashares Global Robotics and Artificial Intelligence ETF. Oh, you've got it there on screen. There you go.
Yeah.
So this is a diversified exposure to those leaders in industrial robots, but also non-industrial robots, automation, and artificial intelligence. So it has some. You can see the big names there. NVIDIA are obviously a key beneficiary from AI. I mentioned Fanuc, but Canon's, ABB. A number of really great companies that stand themselves in good stead. And as you've said, it's very difficult to pick winners in emerging technologies and in spaces of change. So that's a really good way to play that.
For sure. The next, I guess, theme is very much related to this, and I was actually looking at this earlier today for an Australian context. So I'm glad you're bringing this to the table tonight. I was looking, and as a proud owner of a new Tesla, I've got to say I'm very proud. It's obviously changed the game, that company, but also just the overall industry is being changed dramatically by a shift towards electric vehicles. And I was looking in Australia, broadly in Australia, there's still like it's single digit percentages of the number of cars sold that electric vehicles, but in Canberra, it's around 14%, which I thought was quite, I guess, interesting, because it maybe tells you what's to come in terms of, like, Canberra may be a year or two ahead of the rest of the country, but you can see it's already emerging rapidly. So this is only just one part of the energy transition, Cameron. I'm curious overall what you're seeing and how you're thinking about it.
Yeah, so if you look at emissions globally, you can sort of draw a pie chart, and roughly a third of emissions come from direct large-scale energy generation. So coal-fired power plants, gas power plants and the like. And so that's obviously a very important part of the transition, and technologies like solar and wind and potentially some other zero emission technologies, which I'm sure we'll talk about, are very important there. Another really important part is the electrification of other areas of our economies where there is direct emissions, and that includes transportation,
Right.
and also things like industrial processes. So that is, it is crucial that we don't just think about replacing the grid power, but that grid needs to be scaled up in order to allow electrification of our transport fleets and the like. And the spend on infrastructure and vehicles is as high, if not higher, than what will be required on new wind and solar generation. So, that's a really interesting space to look at. I mean, I show a chart here. I mean, the growth in EV sales has been enormous over the last sort of 2 years to 22 there. I think roughly 3 or 4 time multiple over that period. I look at various projections, and some of the more reliable ones, I think anyway, ones that have done well so far, are showing like a 3 or 4 fold increase from this point in terms of EV and new energy vehicle sales from this point until the end of the decade. So it is not going to disappear or slow down. It will accelerate. Obviously, there have been some hindrances with people having what's called range anxiety, worried about finding a charging station. But as technology improves, obviously those issues become less so, and a lot of that's also a perception. It's a lot of this is also about the cost, lowering the cost of producing electric vehicle versus an internal combustion engine. And there's a number of reasons to believe that cost curve on electric vehicles will continue to scale down. And you'll see, clear winners, those who have been forward thinking and position themselves for that transition. And you mentioned obviously Tesla, but there are other companies like BYD is the leader in China. And as per that chart, China, around about half of EVs sold are in China. Volkswagen is a leader, especially in Europe, with regards to the transition from having a business based around the internal combustion engine to electric vehicles. So there'll be a number of winners in this space. We have Drive, which is our electric vehicle and autonomous driving ETF. We think that's going to be a really interesting exposure over a long period of time. There's a long tailwind to go there. As you said, in Australia, we're a bit of a laggard. It's good to see a few more cars like Teslas on the road, and obviously great that you've done that. Globally, electric vehicle sales are about 10% globally, but adoption rates are different in different countries. And I'm sure that Canberra will probably lead the way in Australia, and we'll probably hopefully we'll be at 14% soon, and beyond that soon after that.
Yeah, we were talking on the show not too long ago about Tesla's ambition to drop the cost by about 50% as its competitive advantage, because everyone's racing into the industry, but also to improve things like range and those types of things dramatically, because it's so important. But I've got to admit, like I'm not one of these kind of like acolytes or someone that's like converted. But I've got to say, having driven electric cars now compared to combustion engines, it's just unbelievable. For me, it's like the transition from what we used to have, Nokia, to an iPhone, to be honest, in terms of how much better it is. So,
well, I just took my unfortunately my internal combustion engine car for a service this week, and I'm up for a couple of grand. So, just the servicing costs alone, you can see why it makes sense, even if you exclude the initial reduction in price. So.
Yeah, absolutely. And that's what I'm seeing. Like the cost, the maintenance cost is just not there for electrics too. So it's great. So the fifth and final one is something that is probably gone from. So we've gone from like exciting, talking about companies like Tesla, Nvidia, these types of businesses, and now all of a sudden we're talking about bonds, just to see us off into the night. But this is just a little chart that I pulled up from the internet here that basically just illustrates that the returns from bonds have all of a sudden started to look positive, and that's coming in the form of like income predominantly. But as interest rates have risen over the past few years, people are now starting to think, well, hey, now I can get a return from bonds and fixed income maybe it's time to start thinking about this in a portfolio. So I'm glad you brought this one to the table, because it's something I didn't expect, but also it's such an important part of people's portfolios, Cameron.
So I think I'm going to take exception with some of your comments here. You made it sound like you didn't think bonds were exciting.
Well, maybe they are. Maybe all of a sudden 2023.
That's right. They are, right. Yeah. So maybe one of the reasons, and I think that, like I get things wrong as much as I get them right. But when you asked, what did I think was surprising this year? One of the things why I don't think that the performance of fixed income has been surprising this year is that, and let's delineate here the US fixed income market versus Australia. Australia's fixed income market actually started to turn from June last year. So from June last year, the government bond yield, the 10-year government bond yield, hit 4%, and it's touched that level a number of times. But if we think about the performance of fixed rate bonds, it was very negative in the first 6 months of the year, but the second 6 months of the year last year were actually quite positive, and we've seen a continuation of that trend for Australian fixed income. So that's been very pleasing to see. The US took a little bit longer because their expectations of inflation were maybe a little bit more embedded than here in Australia. But it's great. I mean, it's good to have fixed income back, and I guess, if we think about where we are now, the question is, maybe we're closer to the end than the beginning of this sort of inflation. Are we at the end of the hiking cycle? Our house view would be that maybe there's one more, but that's not going to make a material difference on the outcome of bonds. The question is, what happens on the other side? Are we going to see, inflation completely subside? Are we going to go back to a zero rate world? And look, I mean, some of these other topics we've talked about today, like reshoring, so moving manufacturing from a low wage environment to a high wage environment, that can create inflation. However, as I mentioned, factory automation is actually quite good for productivity, so that may be less of an issue. I would say that the energy transition in the long run is likely to be a bit more inflationary. And so I sort of see, and this is, it's very difficult to predict these things, but I sort of see an environment where 4 or 5% as a 10-year government bond yield is probably, pretty sustainable for a long period of time. And that's driven by sort of underlying inflation. And I think that's a good thing for fixed income portfolios. Like, it means that they have the ability for yields to compress when equities sell off, and you're also getting income. So thinking about portfolios and where we've been on the last 10 years, and the fact that people have sort of rushed to growth assets and private equity, we're probably in a different regime, and I don't think we're going to revert to that. And I think that the role of fixed income is really important, and it offers actually quite attractive value for each unit of risk you're taking on. So I find fixed income really interesting. And honestly, we spent the last 6 months of last year talking to our clients about fixed income because it had changed so much, and they were so hungry for information as to how they should think about that asset class. So that's why it gets me excited. But yeah.
No, that's fair enough. And it should be good news to anyone, particularly people who are more risk averse or in approaching retirement or in retirement, because that's typically where we see a higher allocation to these things. And it makes a huge difference to go from yielding, 1 or 2% to getting yields, 3 or 4%. That's a huge difference for people who have retirement portfolios. And you mentioned some other things around inflation before. I think what you said before about things like the President Biden's decision to spend so much money on things like manufacturing and green energy sources and all these infrastructure around that. Those types of things may mean that inflation does persist for a while, and you see the higher interest rates, or what we've got now, for persisting for some time, which is again good news for income seekers. So that's a really good way to kind of like put a bow on this one, mate. We've covered a few different things today, but just to recap, we've got active versus passive investing. Active investing is facing now not just the traditional index funds, but also smart beta. We've got the rise of already huge US technology companies, a multipolar world with places like China, Japan, and how that all impacts the world economy and ways for investors to play it. Number 4 was the energy transition. We talk about electric vehicles, but also just the grid overall as well. And finally, number 5 was the return of fixed income. So, mate, this is a lot to go on, and I think you've given all of us so many things to think about when we build those watch lists, when we research ETFs, and when we come back to what can we do in our portfolios to ensure that we do kind of, grow the portfolios and grow our wealth over time. So, Cameron, I really appreciate you taking some time out of your Friday to record
Great
this.
chatting with you, Owen. Great
And
chatting with you.
appreciate it, mate. And have a great weekend. And I'll
You
speak to you
too.
soon.
All right. Bye-bye.
Cheers. So that was Cameron Gleeson from Betashares. Heaps of fun. It's always good to chat with Cameron because he brings this kind of big picture, but also that kind of the actionable insights that we always want when we're building portfolios. And now we're going to take a bit of a turn and we're going to talk about things like what actually happens behind the scenes inside of an ETF. So I will be bringing up my screen once again and I will be continuing through this. So a lot of us, what I found in the Selfwealth Live community, but also just broadly, and I'll put my little face over to the side there. What I found in the Selfwealth community more recently is that we've kind of gone beyond just thinking about, well, what are ETFs? How do we put them in a portfolio, et cetera, and actually wanting to understand, well, actually, how do these things really work? Because so many of us are now allocating more money and our portfolios are getting bigger and bigger because of the beauty of ETFs and compound interest. And we're seeing, more people paying attention to the finer details. So that's what tonight's second half of the show is about. Is actually about what actually goes into bringing an ETF here and making it work for us. I'm going to talk on three topics in particular. So how the industry, how the specific players, like how do you see an ETF appear in your brokerage account versus what actually happens behind the scenes. We're going to talk about the indices and how those work and how those are constructed and how that interplays with a portfolio that you own. And finally, I'm going to talk about the different ways that portfolios are built. This is really important because it will determine a significant amount of how your ETF performs over time. So I'll get out my Mr. Squiggle here, and I can imagine people like Paul, Danica, and everyone that tunes in for Selfwealth Live, maybe even Jeremy. I haven't seen him for a little while. He's been popping in and out thanks to his new child. But I know many of you will have questions around this sort of stuff, so I'm happy to answer them anytime you like. But broadly, we have you, the investor over here, right? And what you normally see is you see your brokerage account, you see the ETF that you want to own, and you see maybe the ETF provider. But there are some other actors in between here that are really important to understand. So typically, when you are an investor, you have a brokerage account. So you transfer your money in and you make actions this way. So you log into your Selfwealth account and you click buy on an ETF, say like the NDQ ETF that Cameron mentioned before. That order is processed via the ASX. Here in Australia, we have two exchanges. We have CBOE, and ASX. The ASX is by far the largest, and it's quite unique in that Australia really only has one major stock exchange, whereas you look overseas, for example, in the United States, there's the NASDAQ and the New York Stock Exchange, but here it's predominantly the ASX. Now, what happens is when you place your trade through your broker and your broker submits that to the ASX, typically what's happening on the other side, not always, typically what's happening on the other side is you can be trading with another investor. So let's say this is me and this is you. When you place your trade through the broker and through the ASX, that can be matched with my decision to sell. You're looking to buy, I'm looking to sell. So in effect, our orders can be matched, right, through the ASX. But much of the time, what you're actually doing when you place a buy or a sell in your brokerage account, actually, I can keep these few things here. What happens most of the time when you're placing a trade is you're actually transacting with a market maker. Now, the market maker is not a person, it's a firm. So it's more of a institution. So there's some big market makers throughout the world, and these are big financial firms that trade in the shares. For example, imagine you've got the NDQ ETF, which we mentioned before, which was, if I go back, if I can go back. So NDQ ETF from Betashares, there it is. So if we get this one up, for example, you see, where was I? The holdings, here we go, Apple, Microsoft, Amazon shares. These are all inside of the ETF, right? So what happens is the market maker is responsible for going off and getting, say, for example, Amazon, which is AMZN as a ticker symbol. It's responsible to go and get that. It's responsible to go and get Apple right? And then what it does is it packages it up and it effectively gives that to the ETF provider, right? And the ETF provider can then give the cash back to the market maker. But what's actually in fact happening is you, the individual investor, are transacting with the market maker without even realizing. So there's a company on the other side, and that company has an arrangement with the ETF provider to go and collect the shares and deliver them. And the ETF provider effectively transacts with the market maker. So this organization that sits in the middle here does actually quite a bit of work. But what then happens is the ETF provider issues units. Those units can come through, they present in your brokerage account, and you, the investor, own units. So you get your units, you deposit the cash, and that's basically the way it works. And that's why you have units, because you're effectively getting units while the ETF provider stores these shares on your behalf. So that's typically the way it works. Now, there are some other actors here that you should know about. It's not necessarily with respect to how ETFs are constructed, but just in terms of what you should know. So many of us will know we have organizations like a share registry. And so a big share registry, I'm going to try and write this out rather than type it in. A big share registry in Australia is Computershare. Another one, for example, that does all of the Betashares ETFs is a company called Link. So this company, and I'll show you where that can be found. If you go to the Betashares website and we go, so we can see Link Market Services is the share registry. You see that down there? So you will receive a letter from Link that has the Betashares logo on it if you were to buy this ETF. And you can see the market maker here is Susquehanna. I think it's pronounced Susquehanna. I could be wrong. Very big market maker around the world. But you can see that there. You can see that the registry is here and it's listed. It's also in the PDS. But what the registry does is the registry basically is chosen by the ETF provider in this case. So the registry is chosen by the ETF provider. And what it means is that when this process takes place, they can then send you your documents to say you're an official holder of this. Now, in Australia, depending on which broker you use, the broker also will acknowledge whether or not you're a what we call CHESS sponsored. So if your broker is a CHESS sponsored broker, meaning that you get a HIN, you've probably seen this around, a HIN, H-I-N number. What that means is your shares are also separately identifiable at the ASX. So it's kind of like if the ETF provider goes down, you still have a record of it at the ASX. Not that the ETF provider would go down. They'd just send you the money back, to be honest. But you can get a sense of that not if the ETF provider goes down. What am I saying? If the broker goes down. So if the broker was to go down, so say there's no more broker, the ASX has a separate HIN number for you and your units in the ETF. So that then, therefore, even if this goes down, you can just tell the ASX, you can instruct them to now change broker and to put another broker in place here. So that's the way that works. And that's why you receive the information from the share registry. Now, if you own shares, it's not the ETF provider that chooses the share registry, it's the company. So for example, BHP might choose to use Computershare or Link or one of the other ones. But that's where that piece of paper comes from, if you've ever wondered. Okay, so the final thing is something that we've touched on a little bit on the show, is a lot of people use software to track their portfolios. So you can separately sign up for either one of these two accounts. It's ShareSite or Navexa. They also have free plans, I believe. And what you can do is you can sign up for them and they directly link in with your brokerage platform. So for example, when this trade takes place, for example, right here, the trade has taken place, it will send a message to your accounts in ShareSite or Navexa, and it will say, hooray, you've just made a transaction. We'll record that for tax purposes. So for tax purposes, it's still really important that even if you set this up, that you still go to your share registry and you put in your tax file number. It's really important because otherwise you'll have withholding tax. So you still need to do that at the share registry. This link here is purely for reporting your tax. So here we can see that people use Navexa or ShareSite, for calculating their tax at the end of the financial year. That includes some of the things that get sent from the ETF provider, including like the distributions, but also includes the growth, so you can report the total return. You use your share registry, even though you don't choose them, you use the share registry to put your tax file number in, to do dividend reinvestment plans, that sort of stuff. So we know them. We know that you are the investor. You use a broker, say like Selfwealth. The ASX is a central place that transactions happen. The market maker is effectively the organization that allows you to buy and sell ETFs really quickly. And the ETF provider is the one who overall is responsible for that ETF. So that's that relationship explained. So those are the key players in Australia. Now, next, this is where things get a little bit interesting. And I want to just explain how ETFs actually are born. So here we can see you over here as the investor. Yet again, you're on the left, and you typically transact with an ETF, right? You with the ETF provider. So you know Betashares, right? So you know Betashares because you can see them right here. Now, what is also important to know is that Betashares has to design a portfolio, right? And most of the time, in fact, I think almost always, this portfolio is not necessarily designed by Betashares. Betashares has to use an index provider. So in this case, the index provider is NASDAQ. So that's the name of the stock exchange, but it's also the stock exchange also creates its own indices. Sorry. So here you can see the NASDAQ 100. And if we go into the NASDAQ 100, there we go, it automatically came up. So the NASDAQ 100 index, you can see that's already created. So this represents the top 100 companies on the stock exchange. This is the NASDAQ stock exchange. So like Apple, Microsoft, all those types of companies. So here we can see that in this case, the NASDAQ stock exchange is providing an index called NASDAQ 100. But oftentimes there are other companies which provide these indices or singular index. So we've got MSCI, which is this one. We've got S&P Global, we've got Solactive, and we've got FTSE Russell. So these are the big providers of indices that we see here in Australia. For example, let's bring up a Vanguard fund. So this is one that's really well known. The Vanguard MSCI Index International Shares ETF. So you see MSCI in the title. Let's bring up another one. Let's go iShares. Let's just pick one randomly. iShares IAF. In this case, we can see there's a core composite bond ETF, and I think this is the index is provided by Bloomberg in this case. So let's have a look. Yep, so we can see that the index is provided by Bloomberg. So at the end of the day, the index provider is the one that chooses what goes inside a portfolio. So the index provider provides sometimes quarterly, sometimes monthly, an update to the ETF provider to say, hey, you've got to put this share in your portfolio, or you've got to take this share out. And the ETF provider is obliged to track that. They also do provide consultation back to the index providers. But that would effectively be like the extra square here, plugging in here, right? So that would be this square right here. Now, this happens in the background without you even knowing. But the way that works is that the ETF provider has to pay a fee to the index provider. So here we can see here, there would be a bit of a fee going this way, and they basically send them back the list of companies to buy. And they keep that updated. So these guys provide the research, and you'll often find that these guys over here are the ones that are responsible for ethical or sustainability type research as well. Now, interesting note is that this company and this company are both publicly listed companies. So you can go and invest in individual shares by these index providers as well. So now that we've done that, there are a few other players here that you'd want to explain. So the index, or you want to understand, sorry. So the index provider provides the latest count of shares or bonds or whatever they're tracking every month or quarter, sometimes daily if there are changes, based on entry and exits. For example, if you have a list of the top 300, so say we've got 1 to 300, right? Different companies, and I'll get to this in a minute. And let's say that another company at, say, 301, company number 301 has started to perform really well, and the chart's going up and up and up, and it's performed really well. So this company's got bigger. Well, in this instance, that company would come into the index and another company would drop out. That's just an entry or an exit. So this happens, for example, with the ASX 200, the S&P ASX 200, the S&P ASX 200. That happens every 3 months. So a company drops out, another one comes in. That's an entry or exit. But that's also called a rebalancing. So an index provider will rebalance on a set schedule. So they might say every 3 months, every 6 months, every year, every month, whatever. But there are also entry and exits that can happen due to, for example, if you've got the top 300 companies and number 100 gets taken over or goes out of business, then that one would have to be replaced. So that might happen as an ad hoc thing, like every few weeks there might be one of those. But normally it's rebalanced like every month or two or every 3 months. So in short, when you're doing your research for an ETF, you've also got to research how the index is constructed. And to do that, you will often be taken to these companies' websites, not the ETF providers' website. So you'll have to go over to these websites to find out how it all works. Finally, I want to explain to you how some ETFs are constructed. So I'm going to take this and I'm going to talk to you about what you actually need to understand when you look at what's inside of an ETF. So we know that the index provider effectively tells the ETF provider what to buy, but you've probably heard of this thing called market cap. The market cap of a company, so a share, is just the value of all the shares that are available. So say, for example, let's get a bit of text out. Let's chuck in, say this, and let's say there are 100. Let's say there are 10 shares available in a company, and they're each worth, we'll say $1 to keep it simple. That would mean that the market capitalization, the value of all shares, is $10 because it's just $1 times 10, right? Now, if there were 100 shares, it would be, and there were $1, it would be $100. And you get the picture. This final figure here is the market cap. And what we typically find with most ETFs is their market cap weighted. So say, for example, we get the Betashares. I'll do the NASDAQ because it's been a running thing tonight. Say, for example, we've got the NASDAQ 100 ETF. And here we can see that Apple's got the largest position, followed by Microsoft, followed by Amazon, followed by Nvidia, etc. If we find out Apple's market cap, we can see here that it's a $2.7 trillion company. That's what the T stands for. Now, if we go to Microsoft, we can see that it's a 2.35. So huge, but not as big, right? So that tells us that Apple should be a bigger part of the portfolio. So I want you to imagine that this box here is what's inside the ETF. So this is the total portfolio. So in this instance, Apple might be this big, right? So if you were to buy the whole box, you'd get this much Apple, and you might get this much Microsoft, MSFT. You might get what was next. Amazon is quite a bit smaller, so you might get this much Amazon, AMZN. And what was next? You've got Meta or Facebook, so that's even smaller again. So it might be like this much. So this one might be Meta. I'll just do an M, and so on and so forth. And what you'll find is that the performance of this ETF, if it's market cap weighted, because literally everything from here would get smaller, right? You'd only have like little bits and little bits and little bits until you get all the way up to the 100 that it has. And so by the time you get to number 100, it might only be that much of the ETF. So what you'll find is that the majority of the return from the portfolio is explained by the biggest positions, because it would make sense, right? Like the 10 biggest here that you see are really, going to do most of the heavy lifting. So if we go down to this company is only, Lucid Group's only 0.1%. So that would maybe even be smaller than that little dot there. But you can see that Apple would be the company that's most responsible for that. Now, the market cap strategy is the most common, and it is the most successful of all strategies to weight an ETF portfolio. But sometimes, and this is just for index style ETFs, if you've got an active fund manager who picks individual stocks and whatever, it might be a little bit different. But for the most part, this is the most popular. The next most popular is something similar, but it's not as hard to understand. So for this one, I'll do the same box again. And in this one, we have what we call an equal weight. So let's, for example, imagine that we have a portfolio that has 10 positions. So in this instance, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? So in this portfolio, we have 10 positions and they're all equal weight. They'd all be 10%. So you can imagine that it wouldn't matter if you were number 1, like Apple, or if you were number 10, like that little tiny stock, I think it was called Lucid. It wouldn't matter what really how big the company is. It just matters what the ETF rule is. And the rule says equal weight. So everything gets equally weighted. Now what happens is, how does the ETF actually go up? Well, now what happens is the ETF would rise every 3 months. So say this company goes up in value like this company falls, this company goes like sideways, this company goes up as well, this one goes down a little bit, and so on and so forth. And you get 10 different companies doing 10 different things. And by the end of the 3 months, which might be the rebalancing date, so it might say every 3 months we'll do this. This ETF might go to, say, 12% of the portfolio. And this share might go to 12%. And this one over number 9 here might end up at, say, 9%. And what will happen at the end of the quarter, at the end of the 3 months, is the ETF provider and the index provider will say, okay, we're going to rebalance everything. So this will be sold down and it will be back to 10% again. And the profits will be reinvested into making, say, this one go back to 10% and so on. And that's the rebalancing structure. Now, which one is better? The answer is it depends. So some ETF providers offer equal weight instead of market cap when they believe there is a benefit to all of the individuals being equally weighted. But sometimes this is a better strategy. And what we've seen is in the United States, for example, this strategy tends to work really well because there is a lot of diversification. Even though Apple is big and Microsoft is big, they're quite well diversified in terms of what they do, and they're growing fast. But imagine for a second that Apple wasn't growing fast. Apple wasn't growing fast. Microsoft wasn't growing fast. Amazon wasn't growing fast. Meta wasn't growing fast. Well, in that instance, what you might prefer to have is an equal weight, because you'd get this side of the portfolio doing more of the heavy lifting. And over the past year, what we've seen from the stock market is this side of the NASDAQ has been doing most of the heavy lifting, while this side over here hasn't performed that well at all. So in Australia, this type of portfolio in any equal weight in Australian shares has actually performed quite well. Not always as well as the equal weight, but it's actually performed pretty well. And an easy way to kind of compare these is you go to, say, for example, let's get a different fund. So let's say there is a Betashares fund that is the equal weight S&P 500. So this is the top 500 shares just equally weighted. So instead of 10 positions like we have here, there's 500. And then we can compare that to the IVV ETF from iShares. This one is using a market cap strategy. So basically this thing, but with 500 companies. So here we can see in this ETF, say over 5 years down here, we can see that the total return is 12. Well, let me go the index rather than the fund. So here we can see that the total return is 12.31% per year. For this one from Betashares, which is pretty much the same, but just the equal weight, we can see it's 11.79. So a little bit less. But if it take a different time period, and it might change a bit. Over 10 years, it's 13.83 for the equal weight, and it's 12.86 for the market cap weighted. And so what we can see is a little bit of outperformance with the market cap weighted methodology. But there are instances where it's the other way around. And what you've got to consider, and you can see it's not that big of a deal, but what you've got to consider is what the type of market you're investing in and whether or not you want equal weighting. Like, for example, in Australia, we know that the big banks like CBA and mining companies like Rio Tinto and BHP account for a big part of the market. And a lot of people don't want that. So what they do is they use an equal weight strategy. And that's why the most popular equal weight strategy in Australia is this one right here, the Van Eck Australian equal weight. So it just equally weights shares rather than having the market cap strategy. But all in all, if you're a bit confused by this, you don't have to worry too much. All of this is disclosed on the ETF provider's website and on the index provider's website. And I would say for Australian shares, some people and some financial advisors do use equal weight strategies. They may not use it for all of the portfolio, but they'll use it for some to deflect away from, for example, the resources sector or the banks, and you might get more medium-sized companies. Because effectively what you do when you use this strategy is you get more of the second, where is a different color? When you use an equal weight strategy, you get effectively more of the second half of the table and less of the first half, because you're effectively taking from the big ones and you're giving it to the little ones. And that can work when you think the little ones are going to grow fast. And in Australia, in this second half, you'd have things like Xero, WiseTech, Altium, Pilbara Minerals, etc. And you're basically taking away from CBA and BHP and stuff. So that's why that can work in Australia. But in the United States, this is the most popular because the big companies are awesome. All right, I want to finally leave you with something called a snap test. It's a click of the fingers. And this is a rule that's come from David Gardner in the United States. And it's such a fantastic rule and way of thinking about investing. And it goes a little something like this. Imagine that there is a company out there that if it disappeared, just like that, with the click of a fingers, the snap of a fingers, if it disappeared, would anyone notice and would anyone care? And this is such a simple rule for thinking about the types of companies you want to invest in. If you're a long-term investor, would anyone notice if Coca-Cola here, with my little can, disappeared, or Apple with my phone down here? Would anyone notice? I bought a book on Amazon just before this live show. Would anyone care? And I'd say for those companies, the answer is yes. So this is a really simple test to try and determine if a company that you are thinking of investing in actually matters in the world. Does it actually matter? And that's a really good test to think, is this company important to what's going on in the world? And if it is, it could be a good sign that further research is warranted. So that comes from David Gardner, the co-founder of The Motley Fool, and he's a fantastic podcast host and writer from the US. So next week on Selfwealth Live, we'll be going back and we'll be building an ETF portfolio. We'll have an expert guest joining us for the night for the final installment of Selfwealth Live's collaboration with Betashares, which has been so much fun. You can actually go down into the description for the YouTube session and you'll find a link there, which will take you to a page where you can submit your information and go in the draw to win three by $2,000 prizes. So there's a $6,000 prize pool up for grabs, and you can go in the draw to win. It's really simple. You just have to fill in a little box that says, why do you like using ETFs, or what would go into your core portfolio? It's a really simple way to enter into a competition and win. You don't need to be a Selfwealth customer to enter the prize, but I believe, and Rob could confirm for me, if you do need to be a customer to claim your prize. So go and check that out. It's free to enter. It's heaps of fun. There are some terms and conditions on the page, so go and check that out. But my name's Owen Rask. I'll be back next week live. I'll be in Queensland as this is going to air. So I really do appreciate you joining us on replay. We'll see you next week for the Selfwealth Live version.